Welcome back. Earlier today it was reported the consumer price index was released at 0.4% versus the prior 0.1. Core CPI, which excludes more volatile components of inflation, is 0.4 in line. CPI, and that was month over month. Year over year CPI 4.9 versus 5.0, a slight decline. Core CPI year over year 5.5 versus the prior 5.6. The headline numbers are a little bit softer than last month, but if you read between the lines, especially some of the Fed speak today, even though it's a little soft, it's not really enough of a reason for the Federal Reserve to pivot, to stop their interest rate hikes, and to even consider interest rate cuts. We're not there yet. That's according to at least some of the Fed talk. Here's what the CPI looks like. The blue histogram bars in the background, that represents the regular number that's released, the CPI, which was a little soft today. The black dotted line is core CPI. Again, core CPI does not include food and energy, so it's everything else within the basket of goods and services. The green line shows food. The red line shows energy. Energy has been weak. It ticked up a little bit, but it still has declined quite a bit over the past year or so. But food CPI is still very strong. So there really is not any kind of major pivot. This is CPI in blue, core CPI in orange. Excluding food and energy, inflation is a little higher. So food and energy are actually some of the weaker components of the overall CPI. Energy is red. We can see, that's really the case, and food is in green. If you take core CPI versus core CPI, the white line is core CPI. Again, that does not include food and energy. Think of the red line as including food and energy. That's widening a little bit. So it's everything else that we see out there, the prices that we pay in retail stores, and all those other goods and services. That seems to be rising more so than food and energy. Now, we have some more inflationary numbers this week. We consider CPI versus PCE. The major difference, there's a couple different differences in the prior slide between PCE and CPI. PCE is personal consumption expenditure. PCE includes a lot of government services, Medicare, Medicaid, things of that nature. Now, we can see that they're both tracking very closely, PCE and core PCE. Although that was not part of the report today, we like to talk about it because it is a measure of inflation. Now, here's really what's interesting. The red line represents CPI versus PCE. When the red line goes up, it means CPI, Consumer Price Index, is rising disproportionately to PCE. CPI, very simply put, reflects more of the market that we see. We walk into stores, shopping, that sort of thing. PCE also reflects those levels of inflation, but also takes into consider the amount of money that's spent out there on government programs, which we don't normally see a direct benefit of, like Medicare, Medicaid. It's spread out over time. So when we see this red line rising, it means that the impact to our wallets we feel to a greater extent. That's when this red line's rising. The blue area charts CPI and the yellow is PCE. So the difference between the two is reflected with the red line. Simply put, this shows us that although the number today, the headline might be a little soft, inflation is still rising. And I think that the Federal Reserve, in making their decision whether to raise or pause interest rates, they're looking at many, many different components, and I'm sure they're looking at this as well. And for that reason, personally, I don't believe that we're close to the end of the tightening cycle. This is CPI versus PPI. PPI, Producer Price Index, reflects the inflation that producers see. Now, over time, as the cost to producers rise, it is thought that they'll eventually pass those extra costs on to the consumer. There might be a little bit of a lagging effect. Now, this is CPI versus PPI in the red. That reflects the difference between the two. Now, when that rises, which it has been over the past really 6 months or so, it shows us that inflation on the consumer level is rising more than the producer level. Well, will the Producer Price Index reported next, Will that show also a like in kind sort of hike as well? Or are we going to see a growing disparity between the two? My guess is that PPI will probably follow CPI in the same direction. Today it shows at least the headline numbers a little soft. Finally, we just like to take into consideration what we've seen in the past. We look to the 1970s and 80s as such a historic period of time in terms of inflation. In particular, we mentioned this last report as well. The red line is CPI energy. And around 1985, 1986, the CPI energy component really took a turn to the downside. That obviously predated the very bad stock markets that we saw in 1987. But I just find it very interesting that we had an extreme level of inflation, and CPI energy was the first to turn to the downside. I don't know if that means that present day will follow that pattern, but it is interesting that energy seems to be the laggard of all the CPI indicators that we see right now. Perhaps that's in part because if the economy can't support higher energy prices, if we're driving less, if we're not using as much energy, maybe that's a reflection of a weakening state. Now, getting to the bond market, yesterday we talked about the fact that the 1 month bond, the 1 month T-bill, I should say, was very, very strong as a result of the most recent jobs numbers, which were positive and basically gave us reason to believe that the Federal Reserve would continue raising interest rates just because, at least according to the non-farm payroll number and the unemployment level, those numbers indicate that the job market is healthy. Well, we've seen a little bit of a reversal today, but what's interesting is not so much in the 1 month T-bill. Now, what we're looking at right here is a new chart, is the 1 day change, the difference between yesterday and today in the bond market. The change in numbers here are bips, meaning 100 bips is 1%. So 6 bips, for example, 6 basis points is 6% of 1%. So the 1 month T-bill was down 6 basis points today. Little bit of a softening. The 2 month was down 17. That was the biggest move of the day. Overall, we really see that the entire bond market yield came down just a bit, but it doesn't seem that there's any sort of leader. Perhaps we could extrapolate that, look, the 5-year was down 14 basis points. Maybe today's CPI number indicates that over the long term, into the distant future, maybe the prospect for strong economies is weakening. But you could also make the same argument based on the 2 month T-bill as well. Either way, we would see the soft CPI and we would say, okay, well, if that shows that inflation is cooling, the Federal Reserve is less likely to continue to raise interest rates, and then therefore today's move would be logical. But then again, you look at the stock market, started off kind of strong, but then ended on a weak note. You would think, well, if the expectation for inflation is cooling, that means in turn the expectation for higher rates is cooling. Wouldn't that in turn lead us to believe that's a better environment for stocks like lower interest rates? Well, I think the market is kind of telling us that we don't all agree. The stock market and bond market usually, if there's a strong signal, they'll agree. This is where U.S. current treasuries sits. 1 month T-bill at a 5.5%. The 2 month at a 4.99. 3 month 5.24. We still have over 5% interest rates going all the way out to 6 months, and then we see a massive decline. Really, what's remarkable is a 1 year T-bond is a 4.7. This was at one point the highest yield out there. We've seen, and we've talked about this in the past, that we've seen the highest yields drift to the left side of the charts, meaning the short-term maturities. And that tells us that the expectation for higher interest rates is now only expected in the near-term future. You look all the way out to the 5, 7, 10 years, we have 3%, 3.5% interest rates. That shows us that over the long term, the market sees much lower rates. This is the 1 month change. Again, we still see a positive, a huge move up percentage-wise for 1 month T-bill, up 35%. the rest of the market, I think it's really kind of telling the same story that we've seen in other charts here. The 3, 5, 7 years are down. So the expectation for long-term economic growth is certainly weakening over the long term. This is what the 1 month change in bonds look like. The black dotted line at the top, that's the 1 month T-bill, was very strong. This was as a result of the Federal Reserve meeting. And then we saw, the Federal Reserve meeting was prior to that. Then we saw non-farm payrolls. And then it continues to soften quite a bit. But notice how the red dotted line at the bottom, the 10-year, really, as well as not only the 10-year, the 7-year, which is the brown line, the 5-year, which is the purple line, those are really hugging the bottom and don't seem to have any problem making more progress to the downside. The red line here is a 1 year, the blue line is a 10-year, and we see a continued very wide gap between the two of the inversion, and that's reflected by the blue histogram bars. And then finally, we see here, it's the red line, the 1 year, over the long term seems to be drifting away from the 10-year, the purple line. The black line at the top here is a 1 month. And I like to think about it in the sense that the 1 month, the black line is kind of dragging the 1 year, the red line up. So we have more inflationary numbers this week, and certainly a lot else to talk about in the economic calendar. But essentially, I believe I read we only have maybe one more jobs number and one more inflationary report before the next Federal Reserve meeting. But essentially, I think the bond market could give us some insight into which way the Fed's going to go, especially on the short term. We look at current treasuries. Right now, the 1 month T-bond is at a 5.5, or the T-bill is at a 5.5% yield. If over the course of the next week or so, 2 weeks, do we see the rest of the economic numbers released, if those numbers indicate that the Federal Reserve really is close to the end of the pivots, we're going to see, in my opinion, these high yields get smushed all the way to the left side of the chart, meaning you can see a lot of low candlesticks all the way through here. That the 10, the 7, the 5, the 3, maybe you'll see low candlesticks extend down to the 2 and the 1. And then you'll see less and less candlesticks on the left-hand side, or histogram bars, I should say, on the left-hand side, show this much height in terms of yield. Conversely, if the numbers show inflation, if the numbers show that the economy also can handle the inflation, then I think that you're going to see a continuation of this disparity. Very high histogram bars on the left and very low histogram bars on the right. And that really is the predicament that we're in. Higher interest rates. When the economic calendar says that we have higher interest rates and more inflation, it gives the Federal Reserve more credence to raise interest rates, but only as long as the Federal Reserve believes that the economy can sustain those high rates. If we start to see the jobs numbers really fall apart, the durable goods orders, manufacturing, housing numbers, if those really all start to weaken and really fall apart and fall out of bed compared to our inflationary numbers, maybe that will cause the Federal Reserve to be a little bit more conservative in terms of their likelihood to raise interest rates. So it's a very careful balance, and I think the bond market, like the rest of us, we're all watching the economic calendar. So we'll continue to update you along the way. Very, very interesting times indeed. We hope this has been helpful. We look forward to seeing you back soon.